Amid the pandemic, companies are writing down more of their assets than they have in years. Before that, let us see what charging impairments on assets mean and what it leads to for companies. Impairments on assets are charged when the value of assets is no longer fully recoverable. It usually happens due to changes in legal, economic circumstances, or unforeseen hazards. In the case of the COVID-19 pandemic, there were changes in consumer behavior. The unemployment rate increased, which led to a decrease in the spending power of the people. There seemed to be a focus on necessary items instead of luxury items. As a result, companies such as Walt Disney record a higher impairment as existing assets and investment produce poor returns. This reduces the overall net worth and net profit of the company. In this video, Yilin will start with some real-world examples of big bad, and then I will explain the advantages of depreciation and amortization according to a prescribed schedule, followed by Thet in discussion about the advantages of flexibility to charge impairments on assets, and Jonathan will end the presentation by expressing our view as to which approach is preferable from regulatory perspective. Yilin?
Yes. The companies make provision of goodwill impairment, fixed asset depreciation reserve, and the reserve for bad debts to implement big bars. The objective is to take these losses all at once, so future periods can show a significant improvement in the earning and profit. These accounting tricks often happen in the real world. In 2002, American multinational mass media incorporated Time Warner set a shocking world record, a quarterly loss of 54.3 billion US dollars, among which the recognized loss due to the provision of goodwill impairments was as high as 54 billion US dollars, accounting for 99.9% of the total loss. An optical communication network corporation called GDS Uniface also took a 44.8 billion US dollar impairment charge on goodwill after a downturn in the technical industry in 2001. The same situation happened to another communication company, WorldCom Incorporated. It recognized the goodwill impairment losses of 20 billion US dollar in 2002. Another company called Hewlett Packard, its full year result in 2012, the loss per share was $6.4, including the non-cash impairment charge of $8.8 billion for goodwill and intangible assets. In addition to the large amount of asset impairment losses, companies in Japan, such as Nisa Motor Company of Japan and Shiseido, also recorded one-time expense into the current profit and loss, such as employee dismissed welfare and pensions, and the huge restructuring expenses. The company will benefit in the following 4 ways. First, they may be used to attract the investor and creditors based on the story of an attractive profit earning capacity. The company's financial capacity will be enhanced in the future. Secondly, it will drive up the company's future share price because stocks trade on earnings. An adverse earning report may cause significant depreciation in a stock. When earnings are positively affected by the big bars, the stock price can recover and trade even higher than it otherwise would have without the accounting manipulation. Thirdly, it can eliminates full assets and the non-performing assets formed by the inflated income and the concealed expenses in previous years, which cover up the financial fraud and interprets huge losses as uncontrollable factors such as change in the operating environment and the natural disasters. Lastly, executives use big bars to increase the company's future revenue might result in a larger bonus for them. And new CEOs sometimes use a big bar so that they can blame the company's poor performance on the previous CEO and take credit for the next year's improvements. So, Puteri.
Yeah, thank Thank you, Yilin. Depreciation and amortization are two methods to calculate the value of assets over time. While depreciation is the expensing of a fixed or asset over its useful life, amortization is the practice of spreading an intangible asset's cost over that useful life. There are four main advantages of requiring companies to depreciate or amortize their assets according to a prescribed schedule: matching valuation, asset revaluation, replacement costs, and tax benefits. One of the major advantages of depreciating the asset is that it helps the companies fairly state the amount of expense incurred as a result of using the assets by using an accounting period to properly match the revenue that the asset use intends to generate in the same period. Without properly charging an asset's acquisition cost to depreciation expense, these companies may overstate or understate the total expenses and thus misstate the revenues. It will also then lead to misleading financial information. The depreciation will help the companies to keep track of their assets and see the exact amount of revenue they generated. Next, depreciation will help the companies correctly report assets at their net book value or carrying amount. Initially, companies will record their asset at the original purchase cost. However, eventually, the value of the asset tends to decrease over time due to various factors, most likely cause an asset's depletion. To present a true state of affairs of the business, the companies must adjust the asset's value to its remaining value and show it on the statement of financial position. That is, the original cost minus the asset's accumulated depreciation. Reporting the correct valuation of an asset will help a lot in the analysis process for the business. The depreciation expense is implementing to provide a way to recover the original purchase of an asset. It helps the company to recover the total asset cost over its useful life through periodic depreciation. The depreciation expense is a non-cash expense charged against revenue, which allows the company to reserve a portion of the revenue as funds for future asset replacement. It makes it easier to ascertain whether the asset shall require replacement or not. If the depreciation is not put down, the revenue might be used for the other purpose tactlessly. Last but not least, depreciation helps in receiving tax benefits associated with recording the expense, that is, generating tax savings. Taxation rulings allow depreciation expenses to be deductible against allowable income, arriving at taxable income. The higher the depreciation expense, the lower the taxable income, hence more tax savings. Sometimes these companies use accelerated depreciation to charge higher depreciation expense at a certain period when they expect an amount of higher revenue is in place. The intention is to lower the taxable income and achieve tax savings. Moving on to that.
And one advantage that comes with the flexibility of granting managers charging impairments on assets instead of sticking to a prescribed schedule is increased efficiency. In reality, the nature of the businesses cannot be stuck to one image. Thus, an appropriate room of discretion given to accountants can better explain what was actually happening to the company as well as the economy as a whole. This can be simultaneously seen as a disadvantage of sticking to a prescribed schedule. The value of the assets may or may not reflect the real forecast or future benefits of the economic benefit. Since on-schedule impairment charges are mostly worked with straight-line depreciation with a fixed rate, declining rates of units are produced, whether they're being used or not. Consider Walt Disney. Their long-lived tangible assets, such as amusement park rides, are not being used frequently due to the coronavirus pandemic, but they are being charged impairment charges. Thus, the assumptions and cash flows forecasts used to test for impairments need to be updated to reflect any potential impact of COVID-19. In addition, any other budgets and forecasts from an earlier impairment testing date that were used to determine the recoverable value of the assets should also be revised to reflect the true economic conditions so that the appropriate amount of risk and uncertainty can be addressed. This leads to our second advantage in flexibly charging impairments on assets, having the utmost accuracy in evaluating corporate management. For the management's perspective, they can use the information to reanalyze their company's management and evaluate decision-making ability. A good understanding of the impairment cost helps the management avoid decisions that could potentially harm the company in the future and helps them make better investment decisions. From the investor perspective, they would be given a true overall health of the company instead of an overstated or understated balance sheet. Due to their honesty, the credibility of the company is improved, which makes the investors view them more favorably.
Having analyzed different benefits between granting managers the flexibility and requiring companies to depreciate or amortize their assets according to a prescribed schedule, a question may come to us that what is the preferable approach? I'll firstly introduce some of the important regulators of accounting in the United States, as their responsibilities may be helpful to define their preference in response to the massive widening of behavior. The first one is the Securities and Exchange Commission, which is a governmental agency who regulates the securities markets and protects investors. Their job is to maintain a fair and efficient market. Also, it facilitates capital information within the stock market. The second one is Public Company Accounting Oversight Board, whose responsibilities include oversight of the audits of public companies in order to protect investors and public interest in the preparation of audit reports. The third one is the National Association of State Boards of Accountancy, NASBA, NASBA. The main objective of NASBA is to enhance the effectiveness and advance the common interests of the Board of Accountancy. Since their establishment, NASBA keeps devoting to create innovative methods for accounting regulators, educators, and practitioners to address emerging issues relevant to the viability of the accounting profession. The last one is the Financial Accounting Standards Board, FASB. It functions like what AASB does. It is an independent, non-profit organization responsible for establishing accounting and financial reporting standards in the US. To sum up, it can bring to our attention that the core values and objectives of those authorities encompass maintaining a fair business market, honest reporting, emphasizing on the importance of improving accounting systems and market efficiency. Thus, from regulatory perspectives, our group's point of view is that maintaining the current feasibility for managers may benefit the most in terms of effectiveness. The current generally accepted accounting principles set out rules stipulating companies to follow to ensure transparency and accuracy of their financial reports. It means that the current principles and legislations have already had protective measures against misstatement and deceptive reporting. Also, disclosures and notes on the financial reports can clearly state that their estimation, depreciation, and impairment methods. Other investors and analysts have opportunities to analyze a company by extracting some of the important figures, such as EBITDA, earnings before interest, taxes, depreciation, and amortization, and hence important information as to the company's operating performance without harming the process of getting correct information. On the other hand, flexibility given to managers can to some extent allow management to develop their corporate strategies with the situation they face with and the business nature. Appropriate strategies writing off assets may allow greater room of allocating resources within their business. It also provides the overall outlook to the outsiders and readers of the reports. Another point that the regulatory authorities might look at is the efficiency of the reporting methods. If they change the rules limiting the accountant's feasibility of exert their judgment on impairment methods, the businesses would always find it ambiguous to define whether the writing down is wrongful. If we simply give them a straight line schedule based on the asset's useful life, a fixed rate or pro rata estimation, it might not accurately reflect the actual realizable value of the assets. For instance, let's imagine a supermarket giant has bought many electric trucks in the past years. What if an urgent warning occurs due to safety issues emerge over the world that the supermarket no longer uses these trucks to generate revenue? In these cases, The on-schedule approach will not reflect true revenue of the assets properly. Also, the American regulators need to consider problems of consistency, global recognition, and potential loopholes if they limit the feasibility judgment in writing off assets. During COVID-19, a lot of companies are facing with financial hardship. In difficult times, appropriate leniency of allowing companies to manage their assets is understandable, as long as the companies report their financial performance in sufficient transparency, without misstatement and deceptive conduct. Feasibility of writing off assets may provide another survival kit to the companies. In conclusion, the critique on the current conduct of largely writing off assets is polarized, either of taking big bumps or adopting prescribed schedule provide the ongoing development of accounting system remain the ability of writing off assets based upon the judgment by accounting professionals may be relatively desirable due to the comprehensiveness of financial reporting, as well as efficiency that market values. That's the end of our presentation. I hope you enjoyed the video. Thank you.